Sehgal, and here am I taking the session on decoding the balance sheet for all our new age founders, entrepreneurs who consider themselves as non-finance professionals, non-accounting professionals at the first place. So let me tell you, there is no such concept of telling a person or calling a person as a non-finance professional or a non-accounting professional. I'll start with one quote. The system of accounting is perhaps the most beautiful one in the wide domain of this literature or science. Were it less common, it would be the admiration of the learned world. This was a quote by Edwin T. Friedle, who is a US manufacturer. I'll start from the basics. So there are two basic financial statements which every organization must prepare. All the financial transactions that take place in an organization are recorded and then summarized in these two types of financial statements. One is the profit and loss account. Why is a profit and loss account made? This statement is prepared to find out whether your organization has made a profit or loss. And why would you want to find out whether you have made profit or not? The primary objective of starting a venture, of going on an entrepreneurial journey was to disrupt the market, was to earn profit, right? That is why you have to find out whether you have made the profit or not in your business. How would you know whether or not a business is making profit? Now, this question is dependent upon, you know, many activities. You can certainly go and check how busy your employees are and conclude that it is a profitable business. No, it does not work like that. You have to drive through our business areas, magnificent facilities with an impressive facade, walk inside, see thousands of workers, interact with your employees, and understand that whether that enterprise or whether your company is actually working in the direction, in the vision, and in the mission for which you actually found that, the idea for which you found your company. A business operating from a rundown shack could just be as well be highly profitable as it is not apparently seen on the face of it. So, what tells you whether an organization is making profit or not? There is only one way to know that: profit and loss account. The profit and loss account is made to find out whether or not your organization is making profit. And if it is not making profit, you may need to question yourself whether the business should continue to exist at all. What exactly is this word profit? Profit is a situation when all the incomes of an organization exceed its expenses. So if expenses exceed incomes on the other way around, it results in a loss. In a conventional profit and loss account setup, incomes are listed on one side and expenses on the other side. Sales are the primary source of income for any organization. It reflects the income generated through its core activities. Income from non-core activities also represent income, but they are shown as other income in the profit and loss. To use a bit of a jargon here, the sales figure, which is in a conventional profit and loss account, appears on the top right hand and is called the top line. And the profit which appears on the bottom left hand is called as the bottom line. So you must have heard many people calling top line and bottom line. So top line is sales, bottom line is the profit. Now, what is the business all about? As are we in business to generate top lines, or are we in a business to generate bottom lines? It is very important to always keep in mind that business is not about increasing the top line. We are not in the business to generate sales. We are in the business to generate profit. Top line is merely a means towards achieving an end, and the end to have a healthy bottom line. Another type of financial statement is the balance sheet. A balance sheet is a financial statement that lists an organization's assets and liabilities. Liabilities are what you owe to others. When a business needs money, it borrows. It either borrows from the owners of the business, or in which it case it is called capital, or it borrows from outsiders, which is called a loan. Other liabilities are current liabilities, which may include your creditors, the amount payable to your vendors, suppliers, and bank overdrafts. Assets, on the other hand, represent what your organization own, or the things purchased by spending the money that it borrowed. Typical assets include investments in land, building, machinery, vehicle, computer. They appear as fixed assets in your balance sheet. The second category of assets, called current assets, include items like debtors, cash, and bank balances and inventory. So balance sheet has a common misconception that in order to learn read the balance sheet, you must know how to make them. No, that's not true. You can get it made from your accounts team, and in order to learn it, you can learn it easily by just listening to these sessions of mine. Let me teach you how to make a profit and loss and balance sheet in just few minutes. Yes, it is possible. Where does all the information that goes into the profit and loss and the balance sheet come from? It comes from the accounting records of the organization. How would you define accounts? Accounting is the record of all the financial transactions that take place in the organization during a particular period. Each time a financial transaction takes place in every organization, there is an accountant whose job is to meticulously track such transactions and record them. A collection of such records is called accounts. Why do organizations maintain accounts? As we already know, the primary reason to start any business is to make profit, of course. And profit as seen is not so obvious. Therefore, all transactions that take place get recorded, and whatever gets recorded periodically gets compressed in the form of accounts. This compressed version in the form of accounts is presented in the form of a profit and loss and the balance sheet. So the key takeaway here is so far in the conversation is all financial transactions get recorded as a part of accounts. And when accounts are summarized, their result is presented in the form of balance sheet and profit and loss. This means that everything that happens in an organization over a certain period must eventually appear either on the face of the profit and loss or the balance sheet. Between the profit and loss and the balance sheet, there are four other types of transactions: expenses, income, assets, and liabilities. Expenses and income form part of your profit and loss, and assets and liabilities form part of your balance sheet. This therefore tells you that nothing can happen in an organization which is not eventually going to be categorized as one of these four. There are only four types of possibilities for any transaction that take place in an organization. So if you wish to make these financial statements your way, all you have to look is at every transaction that take place, examine it, assess it, whether it is an expense for you or it is an income for you, it is an asset or it is a liability, and record it accordingly. Your profit and balance sheet will now be ready. Ta-da! So basically, think a moment when your organization stops maintaining accounts. So what will happen? So basically, what it's a complete chaos situation. Accounts are not getting maintained, no track of expense, no track of income, no asset recording, no liability recognition, nothing. So basically, there are still some of the points which you should keep in mind. One is goods or services sold, loan taken, equipments if any you have purchased during the period, interest if you have paid on the loan, rent and electricity expenses, money invested in the other stocks of other companies, dividend if any received on those stocks. So every financial transaction you come up with, you'll be able to classify it. And if you learn to classify it, you'll be better to read your balance sheet and accounts of your company easily. So do you know your debits from your credits? And what is this actually system of debit and credit? So debit and credit are two most commonly used in the world of accounting, yet greatly misunderstood. So I can rarely, come across anybody so far who can confidently attribute a meaning to each of these. So this is invariably a feeling that one is a gain, another is a loss. So one is positive and the other one is negative, but it's hard to find any group who can reach a consensus on what is what. The reason for this confusion is these two words, debit and credit, by themselves. They have no meaning at all. Yes. They are used primarily in the context of the system of accounting. In the use almost all over the world. You go to Australia, you go to UAE, you go to US, you'll find this debit and credit all over. This is called the double entry system of bookkeeping. What is the system of bookkeeping? The double entry system of bookkeeping works on the premise that each transaction that takes place in the organization will have an impact on two account heads simultaneously at one point of time. And the effect on each of these two account heads will be equal and opposite. The word debit and credit are used to denote the two opposite effects of one transaction on two account heads. One account must be debited and the other should be credited simultaneously. These words represent neither good, bad, nor positive, negative. They simply represent two opposite impact of one transaction on two account heads. You now get a further insight into the profit and loss and balance sheet. You know that every transaction that takes place has to be by nature either an expense or an income, liability, or an asset. You have now learned that for every transaction that takes place, the accountant will assign an account head, label it either as a debit or a credit, which means that of the four options, expenses, income, liability, or asset, there must be debits and credits. Now, what are the common expenses that your organization may have? Of course, raw material, of course, your salary payments, of course, your stationery, interest payments, rental payments. What is income that you can get? Of course, sale of services, sale of goods, and of course, other income. Hmm, I'm sorry, I'm having a bad throat, but yes. So, $1 million question. Do you see any difference, or I would say not difference, sorry. Do you see any similarity between expenses and assets? Look at any expense, let's say salary, and pick out any asset. Let's say you pick out furniture. Do you see any similarity between salary and furniture? Yes, there is. Money goes out in case of both. When you pay salary, money will go out. When you buy a furniture, money will go out. So both involve the going out of money. How are incomes similar to liabilities? If both expenses and assets involve money going out, then incomes and liabilities must be bringing money in, right? So, for example, if I give you an amount of money in exchange purchase the goods that you're selling. So this receipt of money will be an income to you because you have sold a product to me. And if I give you some more money, but this time as a loan, it will appear as a liability in your balance sheet because you have taken a loan from me and you owe it to me after a certain and you have to repay me after a certain point of time. So I told you that it's very simple to make a balance sheet. All you have to understand is there are only four options for any transaction that takes place. One, expense, other income, third assets, four is liability. That's it. How are expenses different from assets? Now you know that how are they similar because they both involve money going out. How are they different? So each time money goes out, you are expected to choose. Has this resulted in an expense or has this created an asset? This way your mind should work. One is money spent called an expense, and when is it considered an asset? The connotation expense and asset carry a number of misconceptions. What really decides whether you have spent, whether your money spent has created an expense or an asset is actually the life of that item being considered. You will get is by looking at the titles of these statements, a profit and loss account. The title is the profit and loss account. It is always prepared for a specified period. But balance sheet is at a point of time. A profit and loss account made annually would be titled P&L for the year ending profit and loss account. If it were made monthly, the title would be profit and loss account for the month ending or so on. Figures appearing on the profit and loss account are therefore cumulative numbers for the period. It is a very important point. This means that if you're looking at an annual profit and loss account, every figure in it represents cumulative numbers for the year. Sales would be sales for the entire year. Salary would be salary for all the year, for all the 12 months, entire year, and so on. Whereas a balance sheet is a statement of assets and liabilities as on a particular date. So balance sheet as on this date, you must have seen many financial statements. It is written balance sheet as on this date. But when you see the profit and loss account, it says profit and loss account for the year ending. If profit and loss account is for the year ending 31st December, then the corresponding balance sheet will be the same date as on 31st December. Okay. This means that the validity of every item on the balance sheet holds good only on that particular date, not on the previous date, not on the very next one. For instance, if an amount of rupees 5 lakhs appears under the head bank balance in your asset side of balance sheet as on 31st December, it will mean that the organization had a bank balance of 5 lakh on 31st December. Doesn't matter that they have got this money on 29th or 30th of December itself and they did not have any money or a very little amount of money throughout the year. But your balance sheet says bank balance as on 31st December is 5 lakhs. This means the bank balance was on 31st December 5 lakhs. Financial transactions flow through an organization like a water in a river. If you stop and look around you, you will see production taking place. Customers check arriving, raw material being unloaded, the caterer waiting for payment, your vendors waiting for payment, and finished goods being shipped out. An instant snapshot of all this financial activity gives a balance sheet for that particular moment. How long should the life be for something to be called as an asset? Very important point. Let me ask you two questions to bring this into a perspective. Suppose I buy something that lasts 10 months. Is it an expense or an asset? I now buy something else that lasts only 10 days. Would this be an expense or an asset? So if we look at the life in the absolute sense, we might tend to call that the item that lasts 10 days is a very small lasting for a very small period, and hence it should be an expense, and the one that lasts for 10 months should be an asset. But can it be the other way around? Is it possible for the first scenario that the item which lasts for 10 months be classified as an expense, and the second item which lasts only for 10 days be classified as an asset? Yes, it is possible. Yes, you heard it right. Yes. Let us say we prepare our balance sheet on 31st December and the item that lasts 10 months is purchased on the 1st of January. Since the life of the item is 10 months and the balance sheet is prepared 12 months later, this item will appear as expense. So now suppose the one that lasts 10 days has been purchased on 27 December. If its life is only 10 days, but since the balance sheet is prepared 4 days later, this item will be listed as an asset. Okay. Life should be seen on the context on which the balance sheet is prepared. Always remember that. Anything that exceeds the balance sheet date is an asset. That outlives the balance sheet date is an asset. Let me now give you the most appropriate word to understand where the money spent should be called as an asset and when an expense. The word is consumption. Money spent on something that gets entirely consumed before the balance sheet date is called as an expense. Money spent on something that is not consumed at all on the date of the balance sheet is called an asset. And money spent on something that is partially consumed and remains partially unconsumed, to the extent it is consumed, it is an expense. And to the extent it is not consumed, is called an asset. A primary example of this kind of transaction is a raw material. You may have observed the raw material appearing on the expense side of the profit and loss account and inventory of raw material appearing on the asset side of the balance sheet. The portion of the raw material that was purchased and consumed prior to the balance sheet date is shown as an expense. And the portion that remained in the warehouse on the date of the balance sheet appears as an asset. Do you really know what profit is? Does profit mean money? Are we in business to make profit? Are we in business to make money? So at a basic level, journal understanding is profit equals income minus expenses. Profit, of course, could be a positive number or a negative number, in which case it's a negative number is called a loss and a positive number is a profit. Let us say I start a new business and make the following transactions. I purchase machinery, purchase raw material, and I pay salaries and sell the products. So can you tell me, if I purchase machinery for 5 lakhs, raw material for 1 lakh, total 6 lakh, salaries for 50,000, total 6 lakh 50,000, and I sold the products for 4 lakhs. So I have done the expenses for 6 lakh 50. I have an income of 4 lakhs. Can you tell this whether I made a profit or loss? It may seem that I've made a loss to you, right? It may seem to you that I have made a loss, but this may not be the case. Okay? This may not be the case. Why so? Profit is not money coming in, less money going out. It's a very, widespread misconception that profit is money going in minus money going out. It's not that way. The money received has to be separated into an income and a liability. Money spent must be separated into an expense and an asset. And income less expense will give us profit. Okay. This is the reason we prepare two financial statements. And what are they? Yes, you're right. One is profit and loss account and second is balance sheet. So we are now in a better position, I think, to assess whether I've made a profit or loss. So I did purchase machinery for 5 lakh, raw material for 1 lakh, total 6 lakh, paid salaries for 50,000, 6.5 lakhs, and sales for 4 lakhs. So I've spent 5 lakhs on machinery. Is this an expense or an asset? Of course, it's an asset. The money spent on raw material and salary seems to be expensive. So I have done expenses for 1 lakh 50,000. The sales figure, without doubt, has to be an income. So the profit would be 4 lakhs is the sales, is my income, that is 4 lakhs minus 1 lakh 50,000. So I have made a profit. Yay! And you were thinking I made a loss. No, I made an asset of 5 lakhs and I made a profit of 1.5 lakhs. So have we made mistake again? We have assumed that machinery is an asset, right? And the salary and raw material are expenses. However, just a little while ago, we agreed that it is not the item, but the fact of consumption that determines whether money spent is an expense or an asset. So it's quite possible that all the conclusions we have reached may be wrong, or perhaps they're right, entirely by fluke. Remember, remember one thing. Nothing should appear as an expense unless it satisfies the test of consumption. To illustrate what I mean, let us take another look at our transactions. The first time on the expense side is raw material. If the entire raw material of 1 lakh got consumed in the process of making sales of 4 lakhs, it would be listed as an expense, right? And if a portion of the raw material is lying in the warehouse, on the date of the balance sheet, it would be shown as an asset. So same would apply in regard to salary as well. If a certain portion was paid as an advance, that component will appear on the asset side. This applies to the machinery purchased as well. Was machinery worth 5 lakh, purchased merely to earn 4 lakhs? Let us assume that the raw material was entirely consumed, that there was no component of advance salary. Let us also assume that the study of the machine shows that it did not get consumed. In fact, the machine worth 5 lakh was not purchased to earn, just was not purchased to make sales of 4 lakhs just once. This machine is going to help me earn similar amounts year after year, let's say for the next 10 years. So now common sense tells me that if a single expenditure of 5 lakh is going to help inflate the income side of 10 successive profit and loss accounts, then why should the expense side of a single annual profit and loss account be burdened with the entire amount, right? That wouldn't be fair. The machine therefore should be shown as an asset, not an expense. Otherwise, my single profit and loss account would be burdened in the first year itself. However, having listed the machine as an asset, we are still not happy. While we agree that I did not spend the entire 5 lakhs to make the sales of 4 lakhs, it is equally wrong to say I did not spend anything to earn 4 lakhs of sales, right? So if the expenditure of 5 lakh on machinery is going to help me earn 4 lakhs 10 times, assumably at the end of the first year, I have already earned it once. I'm now going to earn it only for the 9 more years because the total life of the machine is 10 years. This means that if not the entire 5 lakh, at least 1/10 of this amount should be shown as an expense. We must therefore reduce the asset value by 50,000 and this amount will be shown as an expense in the form of the depreciation. In accounting terminology, it is called as depreciation. Yes. So, in other words, depreciation which appears as an expense on the profit and loss account is the consumed portion of the expenditure which has been incurred on the asset. You, amazing, right? So now I can say that I have made a profit of 1 lakh. How? 5 lakh machine asset, 1 lakh raw material expense, all consumed presumably. 50,000 salary, assumably there is no advance. 1 lakh 50 is my expense. Sales is 4 lakhs. So 4 lakh is what I have done is my income. 50,000 is my depreciation. So my total expense is 2 lakhs. So 4 lakhs is my income minus expense is 2 lakhs. So 4 lakh minus 2 lakh, 2 lakh is my profit. This is how we calculate profits. Four terms are very important: expense, income, asset, liability. How to treat an expense, how to treat any money going out as an expense or an asset, how to treat any money coming in as an income or a liability. It's very, very important. So what have we learned here? We should never confuse money with the profit. Profit and money are entirely different things. It is certainly possible for a firm to make huge profits and they still have no money. It is equally possible that it is flush with funds but is suffering losses. Now, if profit does not mean money, it raises an interesting question. Are we in business to make profit or are we in business to make money? Of course, it is the objective of running a business to generate profit, but an equal amount of attention must also be paid to the generation of cash, that is, the generation of money, since profit does not automatically mean money, right? There's no point in making profit if at the end of the month there is no money to pay salaries, right? There's no point in making a profit if at the end of the month there's no money to pay salaries. I repeat. Only half the battle has been won when you're able to make profit for your business. The other half will be won if you're also able to generate cash. If you're also able to generate cash. I'll tell you more about how important this is in my next video. Thank you.